All right, we'll go ahead and kick this off so that we can get you all back to your days in a timely manner. For those of you who haven't met me before, my name is Jacob Timm. I am the president here at 10 Capital. My colleague Ryan Fisher, he's our chief investment strategist. I'm the nice one, he's the smart one, so keep him up here to make sure that what I'm saying is appropriate and that he can jump in if need be. Welcome to Lunch and Learn. I see a lot of familiar faces. We do at least 10 of these a year. This is obviously our mid-year market outlook. In January every year, we do our outlook for the year. So we want to make sure that we always focus on the investments. That's what you pay us for. But we also have a lot of great Lunch and Learns around other topics. Financial planning, Social Security, Medicare. We have a nationally renowned sleep specialist coming next month by popular demand. She was amazing when we had her before. So we like to make these about more than just your money, because when we do financial planning for a lot of clients and we figure out that, okay, you're probably going to be all right, then it's like, great, what does this money mean to us and what are the other things that our clients care about? And it's all kinds of topics. That's what we're going to bring to bear. We're also recording this one today. I don't think a bunch of you are going to be in it, but the idea is we're testing it out. We not only want to be able to send this out to clients going forward that maybe couldn't attend one of them, but we're also testing it out because once we get it right, we're going to start live streaming these as well. So that eventually, we want to see you all in person, because why not? Come get a sandwich, get back to work after that. But we want to make sure that we can get you these in a timely manner as well, whether you want to join in virtually or whether you need us to send that to you going forward. So without further ado, we're going to hit the mid-year outlook or kind of review and market outlook for the year. And we'll dive right into the first slide. So this is one that I used at the beginning of the year. So in January every year, we just look at all of the year-end projections from some of the largest analytics firms so that it's not us telling you where the market is going to go. And by the way, today we're going to separate a lot of math and emotion. So there is a lot of emotion right now around the markets. Political, geopolitical events, obviously how we feel about the economy, the presidential administration, Congress, but we're going to focus on the math because there's a lot of times where there is a very different picture between math and emotion. And it's amazing how often when we make emotional short-term decisions, that can really derail the portfolio, whereas the long-term outlook we usually can get right. But to start the year, when we pulled the average of the 21, largest analytics firms, we saw that everybody outside of one firm said that 2026 would be an up year for stocks. We had, just under half of them or so said that we would have basically double-digit returns for the calendar year. And the average of those 21 largest analytics firms said that we would have an 8.5% up year. Great, and we went through a lot of data at the time around why that might be the case. The economy was clicking along just fine. Inflation was maybe not quite at the Fed's target, but seemingly under control. There wasn't robust job growth, but there wasn't massive layoffs either. And the big one that we focused on was that based off of the big, beautiful bill from last year, regardless of anybody's thoughts on it and what it could mean for the economy long term, in the short term, we had a great slide that showed that the average American that made over $50,000 a year was going to have more real dollars in pocket in 2026. And us as Americans, if we have jobs and money, we will spend it. And that keeps the economy growing. So when we update some of these numbers, because I say these research analysts and these analytics firms are a lot like weathermen and weatherwomen. They make a prediction and then they change it along the way. So just for some updated numbers, the average S&P target based off of where we were at the beginning of the year was 74.29. I was looking at the S&P about 2 hours ago and it was at 74.52. So far, we have kind of hit the average target for what most expected for the year. 7 of these firms have increased their year-end targets. So a lot of them now are still in that 8,100. A lot of these have moved up. No one has dropped their year-end target for the year. And basically the updated average now for the S&P 500 for year end from all of these same firms that have reported is 75.81. So we'll just start there and we'll jump into a lot of maybe why the market could go higher, some of the risks that would be associated with it. But of these 21 analytics firms, 20 of them still believe that not only will the market stay positive for the year, but that we have some room to grow in the S&P between now and the end of the year. Ryan, will you click to the next page, please? So what are we seeing so far this year? And this is a quilt chart for those that have never seen one. And all we're really doing is breaking down all of these different asset classes, US stocks, international stocks, small cap, mid cap, commodities, balanced portfolios. So take your 60-40 portfolio. And what we really saw for a long time, if you go back to, let's just say 2019 through 2024, you can see up there at the top, the S&P 500, so your 500 largest companies in the US by market cap, was the real dominant leader a majority of the time. You heard about the Mag 7 a lot, those 7 largest tech companies, Apple, Amazon, Microsoft, Meta, and how they were dominating the tech space and was driving a majority of the returns that you were seeing from the S&P 500. 2023, for example, in the fourth quarter of 2023, because if we all remember, 2022, Fed raised rates 18 times, stocks and bonds were down in the same calendar year for the first time in over 50 years, and there was just a lot of uncertainty around the economy. Well, 2023 turned out to be a pretty good year for the market, but that really masked a lot of what we were truly seeing. Those 7 largest US companies made up 87% of the return for the S&P 500. So it wasn't that the market was performing effectively. 7 companies were dominating the performance. What I like to see is in the last 2 years, so call it 2025 and halfway through 2026, what we're seeing is more broad-based participation. The emerging markets have really dominated performance from the top end. Emerging market indexes were up 34% last year, 24% year to date. Last year, international stocks, so the EFA, outperformed US stocks. We had had a pretty long run of US dominance and everything else really lagging. We were starting to see diversification work again. Even this year, you can see the S&P's kind of in the middle. Small caps are rallying. Commodities are performing really well. And so what we're seeing now is not only is diversification across the globe working, but the S&P 500, we're seeing broad-based performance. Tech is not just running away where everything else is lagging. We're getting performance across the board. Ryan, anything you want to add to this before we move on to the next slide?
Don't want to steal the thunder from someone.
Okay, so what have we dealt with this year so far? War and geopolitical conflicts. So the big drivers of what we'll call the noise in the marketplace, so separating out math and emotion, is war and the Fed. Ryan's going to talk about the Fed here in a little bit, but I'm going to talk a little bit about what we've seen historically when we're in global conflicts and truly in a war. How do markets perform? What kind of volatility do we have to deal with? And I love this. This is actually a slide that came out right at the beginning of March. So before we knew what was going to happen with the bombing of Iran, but it's amazing how it has played out exactly the same. So what we're looking at here is what happens during geopolitical shocks. So Pearl Harbor, the Cuban Missile Crisis, Iraq's invasion of Kuwait, 9/11, Russia invades Ukraine, the Israel-Hamas war. Sure, we would expect that from the date of the event happening, we would have a downturn in markets. And usually that is based on emotion, not math, because nothing really happens the day after a conflict. It's how do we feel about that? And usually it's pretty negative and people start taking profits or getting scared, selling their stocks. So we usually get a downturn immediately after. What I think is interesting is if you look at a lot of these events that have occurred over the last 80 years, if you fast forward 1 year from that event, not only are markets up a majority of the time, but they're up pretty substantially. And the two times that they weren't, so let's go back to 9/11. So 1 year after 9/11 occurred, markets were down 13.75%. I would argue that that had much more to do with the tech bubble bursting than it did the terrorist attack. Same thing, Russia invaded Ukraine in February of 2022. 1 year later, the S&P was down 5%. Well, what happened in 2022? The Fed raised rates 18 times. So I think that had much more to do with that than it did that conflict. But inevitably, when we have these geopolitical shocks, you have to deal with volatility. Interestingly enough, if you throw out Pearl Harbor, so everything else in the last 80 years when we've had one of these conflicts, the average drop to get to the bottom is pretty quick. So 71 days was how long it took to hit the bottom from the time Iraq invaded Kuwait. Everything else, it was 1 to 2 months, or sometimes just a couple of days. So when you get these geopolitical events, you don't tend to get big, long downturns. And then how long does it take to get back to even from that initial dip? Again, throw out Pearl Harbor, which took about 10 months. Everything else, it was a couple of months. Iraq invading Kuwait was 6 months. What just happened? We bombed Iran on February, I think, 26th or something along those lines. It took about 4 weeks to get to the bottom. Markets fell about 9–10%. And then we came right back, and we were back to even in about a 6 to 7 week time frame. So if you wouldn't have opened your statement for 2 months, you would have never known anything actually happened. The other thing is, what's our max drawdown? So Pearl Harbor, the markets dropped 20% from their high before they started turning back. Everything else was 17, 12, 11, 6, 6. I had clients during kind of that March timeframe reaching out saying, my portfolio is tanking. The markets are falling off a cliff. And I'm never going to laugh at any of you, but in my mind, I'm thinking we are still well within the range of normal downturns. US stocks dropped 9 to 10% during that time frames. So not only were we well within kind of the range of what happens during geopolitical shocks, but one stat that I think is really interesting is if you look at the last roughly 100 years of stock returns, 3 out of every 4 years is up, but the average drawdown in a calendar year, at some point the market's going to go down, is 14%. So virtually every year, we have at least a 10% plus pullback, average being 14%. So even this year, with everything that's been going on, we have not even had a normal pullback in the markets. So even though we have to deal with volatility, and there will be more, of course, we'll get to that today, we don't tend to see big, long downturns that occur during these geopolitical events. They're much more of that what we call the V-shaped recovery. It goes down, it comes back very quickly. So same thing happened in 2025 with Liberation Day, when basically we were threatening tariffs on everybody. Markets dropped pretty quickly, they came right back. The opposite of that is what we experienced in 2022. When the Fed raised rates like they did, that really sent some shockwaves through the market. All right, they're trying to cool inflation, but how quickly is this going to lead to an economic downturn and a recession? That was what we call a U-shaped recovery. Markets dropped, they were down for a while, and it took a little while for them to come back. So that's one thing as investors I think we always need to think through. When we see a scary headline or when we see market volatility, is it coming from a math problem or an emotional reaction? 2022 was a math problem. What we've experienced so far this year from that volatility standpoint after we bombed Iran was much more of a feeling of something could happen, but there wasn't anything in the math that was really throwing anything off. Ryan, let's go ahead and jump to the next slide, and I'll kind of round out this discussion before we get into more economic data. So let's look at truly what happens when we're at war. So some people may say we're in a war right now. Some say, no, it's still a conflict and it could be leading toward a war. Regardless of what your thoughts are, let's look at what happens during wartime historically. So from the time war was declared to when we declared victory, because we always declare victory, right? Regardless of what happens. So going back all the way to World War II, as we can see, the blue line would look at what is our return in US stocks during the time of war. And as you can see, we do not have a negative number. Just for reference point, the last 100 years, US stocks have had a 10.2% rate of return. Obviously, different return profiles during wartime. But what we do see is, this is what's called the standard deviation. It's at 17.1 historically. Just think that's a measure of volatility in stocks. And as we can see, in the last few true wars that we've been in, volatility has gone up compared to what it would have been 50, 60, 80 years ago. This is just Jake's opinion, but I think the reason we see a lot more volatility now based off global conflicts is because we live in a 24/7 global news cycle where we see the bombs drop in real time, and you can sit at home on your smartphone scared to death trading your portfolio, and then that gets the index funds moving with how people are reacting. So we definitely have to deal with more volatility than we used to. But what we're seeing is it's much more of that V shape, down, right back up, than it might have been historically as well. So with that in mind, we're gonna move on next. Ryan's gonna start talking a little bit about, great, we have this conflict going on. We hear a lot about gas and oil prices, the Strait of Hormuz. Ryan, I'm gonna turn it over to you.
Yeah, and I think just to summarize the points Jake made there, if you've been in any of these in the past, we've probably done about 7 or 8 of these at this point. General theme is always that markets in the short term tend to shift based off changes in expectations, whereas long-term returns are much more driven by fundamental data. So, perfect example, what we're going through right now with the Iran-US war is we could have sat here in December. No one really had any strong expectations that we were going to initiate a pretty significant conflict at the end of Q1. So naturally, we see markets react emotionally at first. Cooler heads tend to prevail, reevaluate what the fundamental data is telling us. Typically, that's what's going to be driving long-term portfolio returns relative to these short-term shocks to the system. So specific to what we're going through right now, I know depending on who you ask, it's a war, it's a conflict, it's a skirmish, but really a lot of it is tied to oil. That's been the major ramifications of the initiation of the conflict. And I think to better understand the current landscape and what that means, it's important to reflect back what oil shocks have looked like over the last 15 years relative to what market returns have provided. It's been a very topsy-turvy 15 years when it comes to oil prices, both from supply and demand to, as we'll cover here, a lot of regime changes that dictated some major movement in oil prices. But if we kind of look back over the last 15 years, we can see 2010 through 2014, we were really at a consistent, heightened oil price landscape. And
Orange is oil,
yeah,
blue
sorry.
is market returns.
Orange would be oil prices, blue would be returns of the S&P 500 over that same time frame. So as we can see in 2014 at the end, we see a significant drop in energy prices, almost entirely attributed to, that was the first time that the United States decided that we are going to be a producer and not a buyer of oil. We have the largest oil reserves. We continue to be the largest single provider, both for domestic consumption and global consumption on oil. So naturally, as we saw a huge increase to supply, oil prices fell accordingly. Shift focus back to late 2015. Everything's got a nice long acronym. I think it was the Joint Comprehensive Plan of Action between US and Iran, more commonly referred to as the Iran nuclear deal. That was really a trade-off where the US agreed to lift sanctions, I think more specifically from a trading perspective, from Iran, with the understanding that they would eliminate their nuclear program, as well as put major constraints on their oil supply to the rest of the world. So with that was another shift where supply was artificially lowered by virtue of one of the major providers no longer being able to supply at the levels they were. We see oil prices creep back up, all the way up to 2018 when Trump decided to remove the United States from the deal. What that created was a huge glut of new supply to the market. We see oil prices drop accordingly. It's still I think laugh's the wrong word, but shocks me when we think back to March 2020. I don't know about you, but it doesn't feel like it was 6 years ago. It feels like I can remember it very fondly. That was the most extreme you'll ever see, knock on wood, oil shock from a pricing standpoint was. I know that shows on average a barrel of oil was right around $20. What I can tell you, and what many of you may remember, is there were a lot of suppliers that literally were having to pay people to take supply off of their hand because they had no more room to store it. Surprise, surprise, there weren't a lot of people even willing to take that because there was nothing to do, nowhere to go. Planes weren't running. Outside of spending some time driving the country roads, there wasn't really a lot of destinations you could go to. Definitely, as we came out of that, we saw things creep back up, all the way till 2022 when we really started the kickoff of Russia-Ukraine war. Russia definitely at the time one of the major providers to oil, so very similar to the Iran nuclear deal. Overnight, we had a massive decrease in supply. Demand stayed unchanged. What happens is we see prices spike accordingly. I would say one of the major positive takeaways from that is it forced a lot of countries to reevaluate and diversify their oil consumption. You had a lot of, think Europe in particular, the vast majority of their oil was being provided by Russia. Sanctions are now in place. They now need to go back to the drawing board, find out who we're gonna now be purchasing from, but also it opened a lot of eyes to, we are very susceptible to major downturns for how much concentration we have in who we're buying our oil from. So because of that, you've seen a lot more global dispersion on who's actually providing and where people are buying from. So as we kind of navigated through that, saw another continued downturn to where we hit March of this year. US-Iran war kicks off. Most notably, everybody's heard about the Strait of Hormuz ad nauseum at that point. Major waterway where a lot of oil is distributed. As we've seen some significant supply constraints around that strait, naturally we've seen oil prices shoot up accordingly. Depending on when you've looked, we've had about 15 different ceasefires or resolutions that still yet to be figured out. What I will tell you is this data goes through June 30th. We've now seen oil spike back up to about $80 a barrel as the ceasefire has been lifted and a lot more bombing activity has kicked back up. But I think the major takeaway here is when we're talking about specific to oil prices, countries have become resilient on being able to navigate through those changes and better position themselves to navigate the next big shock to the oil supply. So with all that being said, how are markets, reference the S&P, we've now hit 22 different times an all-time high this year on the S&P index. What is really driving that, knowing that we're having a lot of issues from an inflation and an oil standpoint? It's earnings. It's very easy now, very easy now more than ever just to tie everything to AI. That has become the de facto umbrella term to point towards for any type of market movement, both positive and negative. Has to do with AI. I think we're aware of that, but much more difficult to break down the nuances of what does investing in AI actually mean, who is benefiting it from over the last couple of years versus who stands to benefit going forward. And What I would tell you is the sheer amount of tech-related AI investment this year more than likely will account for about 70% of the total GDP growth for the United States this year. That's a level that hasn't been seen since the dot-com era. Now, I know whenever we compare or reference something to the dot-com bubble, that can send a lot of red flags. We had a pretty significant extended downturn in the early 2000s as a result of that. What we're here to tell you is the landscape is significantly different than what we saw in the late 90s as exuberance definitely got more than what it should have been. And a lot of that has been dictated by the amount of AI investment we've seen, both from the hyperscaler side that everybody's probably familiar with. Think your Mag 7, your NVIDIAs, your Googles. They've really been the main beneficiaries over the last 3 years, call it, because they're very much in the AI generation side of the equation. That is step one. And if you remember sitting down with us in January when we did our year outlook, that was a big topic that we wanted to drive home, that what we saw for 2026 going forward is a major shift from AI creators to AI adopters. And what that has created is across the board, we continue to see some strong growth from the Mag 7 side of the equation, but the rest of the economy is finally benefiting from some of the more ancillary positives of AI adoption. So with that being said, we've now hit 9 consecutive quarters of net profit margin growth. We're now at levels that haven't been seen since 2009. And even take that figure with a grain of salt, because as we know, 2009, we're coming off one of the most significant financial collapses in recent memory. If we're starting at a low point, it's much easier, relatively speaking, to hit a higher growth target. That has not been the case, as you can see. Even at its low point, net profit margins were growing at 11% in 2023, and I've continued to do nothing but grow going forward. And as this top left chart highlights, this would be Goldman Sachs forward-looking earnings expectations. And as we can see there, through the end of 2027, their expectation is that the rate of growth from both earnings and profits continues to increase above and beyond where we're even at right now. What I really like to see is, for the first time, again, kind of in reference to those hyperscalers, we're seeing a broad-based growth to the entire economy. Every single sector that is measured in the S&P 500 has experienced earnings growth. As you may or may not be aware of, this is kind of the key of diversification. Typically, you see certain sectors benefit while others lag. We've seen a broad-based improvement across the entire investable landscape in the United States.
And that leads us to earnings have been strong, so what's really happened? We've had a rally for the ages, but that doesn't necessarily mean that we're in for an immediate downturn. So when we look at the S&P's 4-year rally, it ranks above the top decile of historic returns since 1928. And that's been that bull run that's powered by not only economic resilience that we saw, because I was probably in the camp too in 2022 where, wow, if they're going to raise rates like they are, it's more than likely we have a recession that is, sometime in the next 12 to 24 months, and it just didn't happen. And then obviously enthusiasm around AI. With what we're seeing right now, and obviously this bull run that we've experienced, the interesting part would be, if basically we exited the bear market in October of 2022, that was our low, and then entered this bear run. Some analysts would argue that since technically we touched a 20% correction during that Liberation Day timeframe, that we reset that bull run. But let's throw that one out and say we're currently just under 4 years into this bull run for U.S. stocks. Historically, the average U.S. bull run coming off a bear market bottom is 5 to 6 years. So it's not surprising then, based off of what Ryan talked about corporate earnings, how resilient the economy has been, and seeing all of those forward-looking projections from those larger analytics firms, that there could be room to run in this market cycle. But it certainly has been an amazing rally. What we're trying to do now with clients is not look at what we've seen over the last 3 to 4 years, is what the expectation of the market giving you. A 60-40 portfolio of stocks and bonds should not be returning 13% a year over the long term. And if financial plans are built based off that, or if people start to think, well, that's what I should expect from my diversified portfolio, you will be sorely disappointed long term. But for now, I like this. We'll take it when we can get it. You know, after obviously 2022 being a rough year for a lot of people, with coming right out of COVID, and even though that was a rally that came back fairly quickly, it's nice to see a sustained longer term bull run. So of course there is caution based off what we've seen, but it doesn't mean that because we've had a pretty historic run that it will be coming to an end now. Ryan, I'll turn it back over to you.
And obviously, from an earnings perspective and returns perspective, it's been a strong first half of the year. I would say the one area that we haven't touched on as a result of the oil supply shocks we've seen centers around inflation. And no one's more concerned with inflation levels than the Federal Reserve. The Fed in their own right has had a lot of changes so far this year. So quick lead in, earlier this year, we appointed a new chair of the Federal Reserve, Kevin Warsh. Pretty strong pedigree working within the United States economy. I think at age 30, originally appointed by George Bush on his National Economic Council, specifically focused on the capital markets in 2002. 2006, he was appointed directly by the chair at that time, Ben Bernanke, as the youngest ever Fed governor. 35 years old, I believe. And he was one of the pivotal members. There's some great pieces I'd recommend. I'm a big YouTube guy. YouTube's got some awesome documentaries. So you ever want to YouTube the four musketeers of the financial crisis, he was one of those 4 major Fed governors that were integral in creating the Fed policy to navigate coming out of the financial crisis, and helped implement a lot of the policy that helped get us out of that massive downturn that we saw. Last 15 years, mostly been in the private sector. Stanford guy, I think he's just been teaching econ at Stanford, enjoying the sunshine. But he hasn't been new to being talked about as leading the Fed. He was considered back in 2018 when Janet Yellen was ultimately appointed. He's been in conversation for quite a bit. Now, as what a lot of you have probably kept up on is the old chair, Jerome Powell, and President Trump did not have a very symbiotic relationship. There was a lot of back and forth. So with that being the case, I think there was some surprise to many that Trump's ultimate nomination was Kevin Warsh, because although he does tend to have Republican-leaning track record in his time in various offices, he's also been pretty consistent with taking a hawkish approach to Fed policy. And again, just a quick, I know a lot of acronyms, a lot of terms out here, but just for anyone not familiar, probably know in stocks, when people are optimistic, they're bullish. People are pessimistic, they're bearish. Think of hawkish versus dovish would be a similar counterpart when we're talking about Fed policy action. If you're taking a hawkish approach, that means you are much more concerned about inflation levels. And when we're talking about specific to the Fed, keeping inflation levels in line with what their long-term goal is, which has been pretty consistent at about 2%. We've been well north of that for quite a while. But Powell, who was, I wouldn't say he wasn't per se dovish, but much more down the road. Someone that is dovish, your policy is going to be dictated much more on what's going to drive economic activity, what's going to help improve the labor market. That, unlike inflation, has remained resilient. Unemployment is still at near-term lows at 4.2%. Wage growth isn't exciting, but it's still, I think, latest numbers were 3.8%, so we're still north of what overall inflation numbers have looked like. So again, that's always a positive takeaway. We want to make sure wages are growing at a faster rate than inflation. Otherwise, the actual effect of the dollar people are spending is not getting you near the same amount as it was a year ago, even though you're on paper are making more money. What Warsh is already on record, he hates providing forward guidance. So what that means is we're going to be a lot more in tune with what the rest of the governors are saying, because unlike Powell, who loved to get up and give speeches, I can not so fondly remember us sitting here and having to listen to every single time he spoke, because people were trading literally off of small shifts in verbiage he would use. And it was hilarious to pull up like spot S&P prices. He would say something that was not part of what he said a month ago, markets would drop or spike in the 5-minute span. 5 minutes later, he says something that counters what was said 5 minutes earlier, markets come back. So Warsh, much like myself, he is not one who likes to sit up and give public speeches.
Is he also back in the corner?
Yeah, he's back in the corner.
You're doing a great job, Ryan.
So what that means is we're going to be much more in the dark on what Fed changes may look like going forward, much more dependent on the release of the minutes every month, which dictates what did they discuss at the last meeting. So where does that mean we're at right now? CPI numbers, so consumer prices. Think of this as the major gauge of inflation. Latest readings were at 4.2%. Not anywhere near, that's more than double what the Fed wants to see their long-term target be. So that in a vacuum would be the number one reason we've seen expectations of rate hikes now become just as likely as expectations for rate cuts going forward. I would say the one positive sign, at least so far, is core CPI. So CPI would just be the headline number that's all encompassing. Core CPI is a much better reflection of the main drivers of economic prices, and it excludes the more volatile sectors. And in this scenario, most specifically, it excludes energy prices. So when we look at just core CPI, when we take out the energy inflation spike, we're at 2.9%. Still not in line with what the Fed would like to see, but much closer to the, call it 2.5% trend we've seen in core numbers over the last year or two, which I would take as a positive sign that as of now, inflation impact has been pretty insular to energy prices, and has yet to be more broad-based and spill over into other areas of the market. But that is the major concern right now that the Federal Reserve has, is at some point, the longer we go without a firm resolution in place and restrictions lifted on the Strait of Hormuz, the more likely we see that headline CPI number better reflect the core CPI number. That will be the key component that the Fed will continue to look at in determining if they will hike versus if they will cut. So exactly as we would have told you 3 months ago when the war started, markets are resilient, fundamental data is still strong, but the longer we see oil supply and energy price shocks linger, the more likely it becomes that seeps over into the rest of the economy.
This was the biggest difference between 6 months ago when we did our kind of year market outlook. There was no analyst saying anything about a potential rate hike. That wasn't discussed at all. Now we're sitting more 50-50. Something and it could go up, something that might stay, but that's been a major difference in a 6-month time frame in terms of the outlook.
Well, and even if we look at the far right of that curve, really hammering home the point that now investors are much more in the dark on what Fed policy is going to look like. You can see here that green line would be what the market is pricing in as far as future rate path, whereas the blue would be the current Fed pathway. As we can see here, major shift in that the market is now pricing in a rate hike, whereas the Fed has kind of remained down the middle. As of the last meeting, all 12 of the voting members were still on the same page. We want to keep rates unchanged. But if we look at the broader 18 council, they were split evenly. 9 members were in favor of a hike at some point before we see any type of cut, whereas the other 9 were much more of the standpoint, we think rates stay unchanged and or decrease over the foreseeable future. So now more than ever, the market definitely has their betting odds on what rate path looks like. Fed still very much undecided on what that will look like, meaning even more so the next couple months of economic and inflation data releases are going to be key in determining what they ultimately decide.
We'll hit on a couple more slides before we take some questions, but kind of to synthesize some of the macro views and market views. Yes, from a macro standpoint, we expect, and not us, all of these analysts that we've kind of synthesized the data, expect that risk assets will continue to move higher in the second half of 2026. Risk assets, equities. There is kind of a broad-based consensus that we could see higher returns if we don't get a lot of escalations or other geopolitical events. As Ryan just said very eloquently, hawkish monetary policy could weigh on valuations, and faster than expected disinflation may broaden equity leadership and support core fixed income. Basically just think the Fed is going to play a big role in what we may see happening with some of those forward-looking market outlooks and expectations. Geopolitics and AI will remain key things impacting portfolios. Period. If you really wanted to sum it up, what's going to drive things one way or another, it's going to be how is AI continuing to be looked at as actually creating profits. Right now, a lot of it has been based off of the AI build out, creating a lot of economic activity. Will AI turn into true profitability? And then obviously geopolitics. What is going to happen with Iran? Do we continue to see broad-based escalations? Like Ryan said, every other day, we've come to a resolution, someone violated it, just back and forth. And then past geopolitical shocks historically saw inflation rise and private investment retreat, with public spending increasing on a leg. Today, the dynamics are different. We're seeing it as more of kind of a day-to-day thing that we just have to be comfortable with. From a market standpoint, remaining constructive on global equities. US and emerging markets seem to be the most protected from some of this volatility and that we could see remaining higher. Broadening will continue though, which is great. We talked about that right in the beginning. It's no longer just a handful of companies, especially in the tech sectors, driving the performance. You can get returns across the board. And as Ryan said, basically all sectors are positive right now. A greater focus on energy, defense, economic security. That's led to a surge in public investment, potential opportunities in infrastructure and industrials globally. For a lot of you in here who are maybe close to or in the distribution phase of your investment life cycle, you may have heard us talk about the high income series. So the idea of high dividend equities, quality fixed income, those offer those resilient cash flows. If any of you are taking money out of the portfolio, and we've done some good financial planning, don't worry too much about what the statement says on any given month. That cash flow is very steady. And as long as we're invested appropriately, we can insulate ourselves from some of the shocks that come along with the market. Same thing, private credit delivering compelling yield premiums. And diversifiers like public and private infrastructure, liquid alternatives. Ryan's going to talk a little alts in a second. For any of you who've been around for a couple of years, you hear us talk about alternatives a lot. Alternatives are anything that aren't just stocks or bonds. They can add a lot of diversification to the portfolio. So think real estate, private credit, market neutral funds, hedged equities, things along those lines. They really can help from an inflation standpoint and downside protection. You want to add anything or jump to the next
No,
slide?
and I think that's a perfect shift over to how we think about alternatives. Jake hit the nail on the head. We're very straightforward. It's anything that doesn't carry a lot of correlation to either stocks or bonds. It's a very blanket, miscellaneous asset class in that you have your ones there much more to generate growth, i.e. real estate. You have your much more defensive focused alternatives like a market neutral, help to offset downturns in stock and bond markets. So what I really like to highlight about this chart is we're in a time frame much like 2022, where it's a perfect environment for alternatives to drive some excess returns, both nominally and risk adjusted. Easiest way to think about this chart, may be familiar with the VIX index. All that is a measure of stock price volatility.
They call it the fear index.
Yeah, the fear index. So when the VIX spikes, that typically tells you that markets are uneasy and volatility ramps up. Lesser talked about one would be the MOVE index. That would be Merrill Lynch Options Volatility Estimate. Think of that as the VIX for treasury bonds. 2022 was the last prominent example of this, where in an environment where we had a outsized increase to stock volatility, at the same time we saw a spike in treasury yield movement. That is the exact time that you want to maintain your exposure to the alternative landscape, because by design, that's why you're holding those positions, to help offset that increased volatility you're getting from the traditional side of the portfolio.
And for as much as alternatives can maybe be a little confusing or hard to understand, like what the heck are they talking about? If you're a client here, more than likely you have alternatives in your portfolio currently, and we will make sure that they are the appropriate ones. Oh, yeah. I'm just going to hit on this because I know it's top of mind. So, political parties and stocks. So one thing that I think is important to remember is just because we hear about politics every day and we all have strong opinions about politics, and it's been years now that it's whoever is in office, some people are really happy, some people are not. And all too often we conflate the politicians and the market as being the same thing. This is just a chart that shows under a Democratic White House, a Republican White House, whether or not there is alignment or not alignment in Congress, whether it's split or not, we do not get a massive difference in returns, and a specific political party or congressional leaning does not equal long-term downturns in the market. We are headed into a midterm election. Yes, there will be volatility. Yes, there will be a lot of negativity. Unfortunately, social media and the mainstream media really understands the formula. The more negative and salacious they are with their headlines, the more likely you are to pay attention to it. And we're no different, but my point is, there is a lot of negativity in the world right now, and there's a lot of things to be worried about. But I always say our job is to separate the math and emotion and focus on the math. And for you all, just so you can sleep a little better at night, don't think that any specific thing you're hearing in the news, or especially about politics, really has anything to do what is going to drive the markets long term. I would imagine we'll see some volatility in the fall. And just interestingly enough, when you look back at the last 60 to 70 years of markets, at some point during the year, the market is going to peak. And well over 80% of the time, the market either peaks in January or the fourth quarter. You don't get a lot of mid-year market peaks. It did not peak in January. So math would tell us that we're going to get a fourth quarter peak. Interestingly enough, over 50% of market peaks are in December. I'm not calling this, but it wouldn't shock me at all if we got through some midterms and everybody calmed down a little bit and we had that fourth quarter rally that we see a lot. So based off the math that we're seeing so far, a lot of the analyst predictions, that wouldn't surprise me at all. But this is just to say, don't take your politics and match them up with your portfolio and make decisions based off how you're feeling at the moment, because most of the time you're going to get it wrong.
Well, as many of you are aware, guarantee is a big no-no word in our business. But I can confidently guarantee that the midterm elections will be talked about as if they are the number one most important thing to markets and returns. As best you can, it's important to stay in tune with what's going on, but when we're talking specific to what history has shown in market returns, it's best to kind of put your head in the sand and ignore the noise.
Let's hit some key takeaways, answer a couple questions. If you got to go, that's perfectly fine. A new geopolitical paradigm. Geopolitical shocks are no longer isolated events. They're now structural drivers of not only the macro regime reshaping trade, supply chains, industrial policy. Ryan talked a lot about that earlier. And resilience drives outcomes. Recent developments in the Middle East have demonstrated economic security, strategic autonomy, and resource access are becoming increasingly important. I think that's been going on since Russia invading Ukraine.
Think Europe in particular. Yes. Coming out of Russia, Ukraine, it initiated a lot of shifts in their approach to a number of different things, but economic policy in particular. For the first time ever, Europe, for the most part, has shifted from free trade to protectionist, much more insular, a huge increase in funding of the defense sector, really trying to highlight where their risks are and look to change that as quickly as they can, which will continue to provide a lot of good opportunities internationally.
And to that point, countries respond differently to the shocks that we've seen the last couple of years, and returns are increasingly regime and regionally dependent. So really looking at what we just look at as active allocation. Know what's in your portfolio. Know what, and we do, I promise, but for any of you who are doing it yourself or have outside investments, know what's in your portfolio across asset classes and geographies. Understand where there is maybe an asset class where it's like, yeah, I can track an index and be okay. Or especially for more active asset classes, like you'll see a lot of the times, emerging markets, asset classes outside of the US, it's good to have really smart people making those day-to-day decisions on what companies are in portfolios. So with that, we're gonna quit talking. What questions do you guys have? Any questions top of mind? And again, if you have to go, that's okay too.
100, that's good.
Oh. Yes, sir.
Yeah, thank you so much. A great presentation. I want to go back to the Fed and the role of President Trump. And you talked a little bit about conflict with Powell. I'm wondering, do you just expect or hope that he will be less public in his seemingly constant drumbeat to lower?
I would not expect But with that being said, as we saw with Powell, there was a lot of animosity, a lot of threats. I think Trump learned firsthand that by design, the Fed is meant to be separate from the US government. And with that, the president does not have a whole lot of options to outright remove a Fed chair or go in and disrupt what the Fed is doing. Which again was kind of lent to the surprise of the ultimate appointment, because Trump has been as dovish as you can be in saying lower rates now, boost earnings, lower mortgage rates, so on and so forth. Whereas the Fed's take has been, no, the exact reason we aren't doing that is because as of now the economy looks good. The only negative is inflation. If we're going to start cutting rates, that may provide some additional nominal benefits to economic growth, but potentially could cause a lot of significant increases to inflation that would wipe away any benefit you're getting from those cuts.
So do I take your hope or interpretation?
It will still be talked about. I think the president and will let it be known when he disagrees with the next decision the Fed may make. Ultimately, I think it's a lot more bluster than what he could actually go in and change.
And I don't think Warsh will care.
Yeah, Warsh is pretty good, kind of to that point. He shuns the public eye. He's not looking to get into the mud. I think him and Trump, at least on a personal level, seemingly have some background.
Yeah.
So there's a lot of caveats there, but I would expect the back and forth to continue. I wouldn't expect it to amount to any type of material changes.
Other questions? Yes, ma'am.
Out of control spending and the national debt.
Yeah.
Isn't there a point when that really ties the hands of the Fed to do anything and things kind of go
Yes.
insane? I mean, that will impact everything.
Yeah. The interesting part, I just read an article on this, and I'll give kind of the same response that I gave last year. Yes, but it won't happen yet. So we've been dealing with this for a very long time. And yes, we are certainly at the upper end historically of debt to GDP. It's not massively outside of the range of inflation adjusted where it would have been over the years. And this is a constant discussion point. It will definitely have to be dealt with at some point, but I do not see it having a major impact, not only on what the Fed will be doing, but on markets as a whole, at least in the coming few years.
I'd say as long as we remain a base currency for a lot of the rest of the world, that will continue to help insulate concerns from a deficit level.
Yeah.
Just because everybody is continuing to transact in our currency, that's going to give us a much better position to navigate the concerns there versus other countries that may not have that luxury.
Other questions? As you all know, we're always here. So reach out to your advisor, reach out to one of us if you have questions. No, the world isn't rosy right now. I don't think it's as bad economically as what the media may paint it to be. Lots of concerns. I wouldn't just go dump all of your money in risk assets because we think there's potentially an opportunity for it to go a little higher. But I think we're in a place now where we know how to navigate it. We're going to make sure and not make emotional decisions on behalf of all of you that we're very thankful that you trust us with your hard-earned dollars. And again, reach out to us whenever you have questions. Thanks, everyone.